Hi, I'm James Surowiecki, the New Yorker's business columnist, and we are here today talking with Barney Frank. Barney Frank is the chairman of the House Financial Services Committee and one of the most influential members in the House of Representatives, played a key role during the financial crisis last September, and will obviously be one of the most important and influential figures going forward in terms of thinking about reform of the financial system and so on. So we're here to talk today about that, healthcare, many other subjects as well. But I want to start by asking about the sort of financial system. Can you give us a kind of picture in your own mind of where you think the state of what you think the state of the financial system is right now in terms of its health and?
Well, it's on the way back in terms of activity, but we want to do what we can to make sure that the healthier parts come back and not the rest. You need to have a conduit between a lot of people, and this is the historic model. There are a lot of people with relatively small amounts of money. And for there to be productive investment in the society, somebody's got to assemble those small amounts of money into big packages and make them available to people who will produce factories, who will produce services, who will produce other things that people need. And the role of the financial community has been, the financial service industry, has been to intermediate between those. Now, in the past, it was done in a couple of ways. One was by people buying stocks directly in the companies. And the other main way was by loans that were made by banks which took deposits. And essentially, I think what happened was this, that the financial system got more sophisticated. In general, that was a good thing. As you securitize loans, you can lend more money. Because if I lend you money and have to wait 30 years for you to repay, I can't re-lend that money for a while.
Right.
If I lend you the money and sell the loan, I can lend it again. And if I'm lending under good criteria, that's a good thing. So our job in regulation is to try to preserve the value of the innovations. In this way, it's close to what Franklin Roosevelt had to do, or what Theodore Roosevelt and Woodrow Wilson did. You get innovation, you don't have regulation, so the innovation outstrips the rules. We want to maximize the ability, or have rules that allow the financial industry, because the government plays a passive role here, that allows the financial industry to maximize the extent to which it can gather up money and make it available, but minimize the extent to which there are things that happen as ends in themselves, because that's how we get in trouble.
So can you give us a sense of how confident are you that government can do that, that you can strike the right balance?
Very confident, because we've done it twice before in American history. In the late 19th century, we had a terrific set of innovations, large industrial enterprises, right. Coal, steel, railroads, etc. Those didn't exist. If you look between 1850 and 1890, there's a transformation in the American economy. Now, those were good things because they gave you the ability to generate more wealth, but there weren't any rules. So Roosevelt, Theodore Roosevelt, and Woodrow Wilson spent much of their time coming up with rules that allowed the good but diminished the bad. The Federal Trade Commission, the Antitrust Acts, the Federal Reserve System. Then that in turn led to the stock market, because now you have enterprises that are beyond the financial reach of any one small group of people or families. So what you got was FDR essentially saying, you know what, stock market's a good thing if it's run right. So you had the Securities and Exchange Commission. You had federal deposit insurance. And that worked very well until, I'd say, it started to break down. We didn't quite realize it about 25, 30 years ago. It's now broken down.
So now, do you view deregulation as central to what happened in the housing bubble?
There was some deregulation, but it was more non-regulation because, and you know, you talk to bankers, particularly smaller bankers, community bankers as they are called, they're very angry when people blame the banks for the subprime crisis because on the whole, it wasn't the regulated financial institutions that did this. What happened was a whole set of institutions grew up that could make mortgage loans that were not part of the banking system. Banks made mistakes. Washington Mutual was a bank. They were an outrage. But most of the loans, and a very high percentage of loans made that went bad per entity, were made by the non-banks. And the other problem was not deregulation, but non-regulation. New phenomena grew up, and there were no rules to cover them.
Now, going forward then, in terms of, one of the things that's curious from the outside when you look at Washington is the way, in the debate about regulation, is the fact that regulators are squabbling amongst each other, it seems, constantly.
There is a legitimate difference of opinion, I would say, where the regulators will have some impact over the question of who should be in charge of the systemic risk issue. Okay. Essentially, that means who prevents any company or set of companies from getting so big and so vulnerable that they could collapse and cause us problems, as Lehman Brothers did, as AIG did, as Merrill Lynch did. On the consumer product issue, yeah, there are debates about how to do it. I will say this, none of these financial regulatory agencies, the Federal Reserve, the control of the currency, the FDIC, none of them can show you any record of consumer protection. As a matter of fact, in the cases of subprime loans, the Federal Reserve's record is abysmal. Now, that's not purely institutionally the Federal Reserve. It's Alan Greenspan, who was an extreme ideologue on the case of regulation. Ben Bernanke, to his credit, has been more active as a consumer regulator, but even here, in every case where the Federal Reserve under Bernanke has done any consumer protection or other kinds of regulation of that sort, it was provoked by Congress acting, at least some part of Congress.
So you think we need a separate consumer protection agency,
yes,
basically? Okay.
Yes, because the bank regulator's main function is going to be the banks, and they are going to work with the banks, and they're going to be influenced by the banks. That's not bad. That's inevitable. We need a separate standalone agency. Now, the standalone agency will be operating in the same legal structure, and if the bank regulators think the standalone agency has gone too far, there'll be a mechanism for resolving that dispute. But the history is overwhelming. People whose primary role is to nurture the health of the financial institutions are not going to be good protectors of people against those institutions.
Right. I actually want to just go back just for a little bit to September, to that week when Lehman goes under, AIG, et cetera. And what happened with TARP, the first attempt to pass the TARP. I mean, when the first bill comes to the floor of the House and it fails, the market, goes down, whatever, 780 points. Were you surprised when that vote failed? I mean, or did you know going in that the votes were not there?
I wouldn't have been surprised by either outcome. It lost by more than I thought. We got more Democrats and fewer Republicans, and we thought this was George Bush's number one.
This was the House Democrats and Bush working together.
And the Senate Republicans who were very supportive too. I was surprised by the margin. I will say this, though, as it became clear that it wasn't going to pass, the instinct of both the Democratic and Republican House leaderships was, and it's responsible, it's their job, well, let's see if we can persuade some people to change their minds. I, at that point on the floor, said, no, that's not a good idea. This is of such fundamental import to the country, and it's so controversial. If it looks as if it was done with any shadow of excessive pressure, it's just going to blow up even worse. Let's let it happen, and let's see what the reaction is.
Okay. In retrospect, you did eventually pass the TARP. There's been a lot of backlash from left and right against it in a way. Are you confident that it was the right thing to do?
I think it was the only thing to do. And yes, there's been backlash. If we had not done it, things would have been much worse than they are today. And now there are two arguments for that, by the way. First of all, I believe that the reality was that way. I don't think Bernanke and Paulson were exaggerating at all. But secondly, even if you think they did exaggerate, from our standpoint as the Congress, given that, then we had no choice, because when the Secretary of the Treasury and the Chairman of the Federal Reserve say, if you don't do this, it's going to be a disaster, then if you don't do this, it's going to be a disaster, probably even if it wasn't. So I'm not accusing them of self-fulfilling prophecy, but that was a reinforcement.
Right.
And, yeah, I don't think there's any question. Now, I think the TARP could have been done better. I think there should have been more leverage. My only disagreement with Hank Paulson was I think there wasn't enough leverage on the banks to do more about foreclosures right away.
Now, because of what's happened with the TARP and then the decision not to nationalize and effectively to, in a way to allow the banks to recapitalize themselves via the public markets and also via profits, is there a tension right now between we want the banks to be profitable because that's the only way they can recapitalize themselves, and people being angry at the fact that the banks are profitable?
Well, no question, although I think it's not so much that the entities are profitable as that individuals are profiting excessively, and you have to make that distinction. Look, the difficulty we face with the banks, now I'm talking about a very different order of moral error here, so I want to be very careful, but it's kind of like de-Bathification.
Okay.
One of the mistakes the Bush administration made, well, the biggest mistake, of course, was go to Water Rock, the biggest, stupidest, worst, most damaging single decision in American history, in my judgment. But once they went in, they then decided to de-Bathify, so they fired everybody who knew how to tie her shoes. And that was our mistake, not our mistake, that was a decision that the administration didn't make with the banks, and we didn't try to press them to make. Yeah, there was some tendency to say these people are all bad people. They weren't all bad people. A lot of them made mistakes. But if you had sort of dismantled them, then what would you do?
Right.
Of the first $200 billion that was loaned, this is about a month ago, I haven't got updated figures, in the first year to banks, over $70 billion had been paid back within 10 months. Some in, actually $74 billion, some in 68 principal, 6 in profit. So the perception hasn't caught up with the reality.
Right.
Here.
So in terms of executive compensation, which is an issue you've been out ahead of and want to do something about, what do you think the chances are of getting meaningful regulation of executive
Very
compensation?
important. We're going to get it. We have good restrictions in place on the TARP recipients. There is this problem because the TARP recipients can argue, well, we're at a disadvantage versus non-TARP recipients. My answer is good. Let's regulate everybody. That,
Okay.
you know, the answer when you have this disparity is not to let everybody out. And our problems with compensation for everybody now, not just TARP recipients, there are 2. One, that too much money is being paid. But that's not the federal government's decision to make. It's the shareholders' decision.
Right.
So part of the bill says shareholders will get to vote every year on what they think about the compensation. It's not binding, by the way, because if you made it binding and it lost, you wouldn't be able to pay anybody.
Right.
But the experience in England, where we've borrowed this from, is that boards of directors don't ignore those kind of votes.
So even if it's just a say on pay, that actually makes a difference.
That makes a difference. We have also, at the request of the administration, strengthened the independence of the compensation committees of the boards and restricted the compensation consultants. I'm skeptical that's going to work. It won't do any harm. I don't think the boards of directors, you know, the boards of directors and the CEOs and the other top people, they've got to work together so closely. It's unrealistic to think that one day a year they'll be at arm's length from each other, and I'm labor and you're management. That kind of role playing isn't going to work. So what we then said is, look, over and above the amounts that are paid, our problem is the incentive structure. These people are allowed to play with other people's money. They can take risks with the company's money, and if enough of them take risks with the economy's money, not the government, the economy's money, without any risks to themselves. Because if they take a big bet and it pays off, they make a lot of money. If they take a big bet and it blows up in their faces, they suffer no penalty.
Right.
So what we have done is...
many of them walked away with huge sums of money
anyway,
in the short term, and then,
So we paid, we passed a bill in the House that mandates the Securities and Exchange Commission to regulate pay as they regulate all manner of things. You're a public corporation. You have to submit to the SEC your plans, and you cannot have a system which incentivizes too much risk. You can't have a system in which people are given the incentive to take risks because they will be rewarded if the risk pays off and in no way hurt if it doesn't.
Okay, now the other thing we talked about that you've been talking about, and I think is very important, is this question of foreclosures. And this is, the Obama administration rolled out a $75 billion plan that's trying to do something about it. It does not seem to be very effective. All these plans sort of depend on the idea of giving the banks incentives to modify foreclosures. They haven't seemed to pick up on it. What more should we be doing?
I think the only thing that will really substantially change this now is to give individuals the right to declare bankruptcy with their primary residences. Bankruptcy gives the judge the right to reduce the loan, and it breaks through 2 legal tangles, the servicer-investor tangle and the first and second mortgage tangle. Bankruptcy cuts through both of those in ways that we aren't able to do without it.
Right.
There is one other thing I want to do, and I would take some of the profit we're making in the TARP repayments, the interest and dividends and warrants, and lend it to people who have lost their homes, who have lost their jobs and face mortgage problems, but to be repaid.
Well, so, but it would be a direct
right, because here are these
right.
problems with people who don't have there's not a misalignment between their earning capacity and their mortgage,
right.
except that now out of work for 8 months a year, 14, 15 months.
Right.
And so it would lend them the money, and then they would have to pay it back over time as they got back to work.
Now, housing is obviously something that you've been interested in for a very long time and an advocate for, and you are often kind of blamed in some form or another for the housing bubble. And yet, at the same time, you are actually probably the biggest critic in Washington of what you could call the kind of cult of home ownership, right? Yes. This idea that everyone needs to own, and somehow renters are, I don't know, lesser beings or something like that. So do you think that cult of home ownership played a role in the inflation of the housing bubble?
Without question. And, and it's true, one of the things is just my being blamed, and there's a very real reason for it. I'm chairman of the committee in the House that is going to have to take a lead in regulating the financial industry. And there are people who don't want that done for 2 reasons. There are ideologues who believe in that freedom includes your right to be highly leveraged in your derivatives, and it's a diminution of your personal freedom if you can't do that. And secondly, people are going to lose money on it. So I've become the target. If you go back to the period before the Democrats won the 2006 election, I don't show up as one of the problems there. In other words, it's a retroactive thing. Wait a minute, this guy's going to try and regulate. We got to discredit him. So,
okay.
The other flaw with it, of course, is precisely what I just said. I was in the minority in the House from 1995 to 2006. So all these things that happened in 2002, 2003. I mean, Tom DeLay wasn't taking orders from me. I was critical of home ownership. Under the Republicans from 1995 to 2006, they essentially abolished every program we had for helping the federal government build family housing that was for lower income people. We're going to get back in that business and do it in ways that I think are going to work. The one argument is, well, if you have this kind of subsidized housing, it ruins the neighborhood.
Right.
All right, I invite everybody listening, come to Boston and go to the corner of Tremont and Arlington Street. On one side, the south side, is a large red brick block-long complex known as Castle Square, one of the earliest affordable housing programs built under a program known as 221D3 runs, and it's hundreds of units of low-income housing with a public housing unit for elderly in the middle. Across Tremont Street, but it's a wide street with a divider, is the most expensive private housing in Massachusetts. It's called L'Atelier. It's a very swanky condominium where you get concierge services, etc. Now, these two buildings are 200 feet apart at most.
Now, healthcare obviously is on everyone's mind. Is there a challenge, though, in the one thing that has struck me about a difference is that with, I would say maybe all, but certainly most of the great triumphs of the welfare state, essentially were created almost out of whole cloth. So, you know, there really was no old age care. In this case, you have this strange situation where 70% of the people...
That's a very good point. People
they say they're okay with their health care.
They're worried about what could happen.
Yeah.
But there's one other problem, and I'm afraid that President Obama has, I think, copied the biggest mistake President Clinton made, and that was the notion that you could bring in people who were uninsured without any additional revenue outside the system.
Right.
And that's what scares people. That's what most frustrates me, I guess, is this, well, you guys are raising the deficit. When people who voted for the Iraq War, it will have cost over $1 trillion. If we didn't have the Iraq War, we could have paid for health care twice over, right, probably. That's what's so frustrating. I was at a meeting that I was asked to go to, and they said, what about the deficit? I said, well, you know, the war in Iraq. What's the war in Iraq got to do with the deficit? I said, well, who the hell do you think paid for it? Santa Claus? I mean, it's ludicrous. But that's what's very frustrating. But it is, I do not think Obama's plan will damage anybody else's health care. But by saying we're going to do it with no additional funding, he uses that. See, I think that's wrong. I would say, look, it's going to cost some more money. Let's pull out of Iraq early. Let's, you know, and some of it is coming from increased taxation, including ending tax evasion, overseas tax evasion and manipulations, where you do a transaction purely for tax purposes. But that is a very good point you make. When nobody has anything, it's easier to do something.
Right. You have this reputation as a hardline Democrat, but you're the main force behind this bill trying to get internet gambling legalized, basically. It seems to be, for some strange reason, a very difficult task. Can you just talk a little bit about why you're in favor of letting people gamble on the internet?
Yeah, it's their own business. I'm very much a libertarian in the non-economic area. Now, actually, I'm really puzzled as to why my liberal friends who agree with me on some of these areas turn against gambling. It's kind of like, I think gambling is to many liberals what pornography is to many conservatives. I think it's tacky, so they want to prevent other people from doing it. And people say, well, it's not in their interest. Well, neither is eating too much red meat, neither is not getting exercise, neither are a lot of things. In fact, it's very ironic, some of the conservatives who say total freedom from the internet make an exception for gambling. And it's just so obvious to me. If an adult wants to gamble with his or her money, you let him. And people say, well, they're addicts. Yeah, well, if you're going to ban anything that some people get addicted to, we'd all sit home and stare at each other. Yeah, it's ridiculous.
All right. Well, that was the last question I need to ask you. So
okay.
I really appreciate it. Thank you for spending
You're
time
welcome.
with us today.